Yeah. Hello, everyone. Welcome you again for day 3 tax audit session. That is webinar that is organized by Bengaluru branch of ICAI and SICASA Bengaluru. So for day 3 of tax audit session, we have CA Kaushik Raghunandan as the speaker. CA Kaushik Raghunandan is a fellow member of ICAI, having qualified as a CA in November 2017. He's a graduate of commerce from the Indira Gandhi National Open University. He has completed a GST certificate course conducted by ICAI. He was a partner in G. Ananta and Co. Chartered Accountants for 4 years, where he was handling tax audits for corporates and non-corporates, statutory audits of corporates and NGOs, internal audits of MNC clients, and taxation of HNI client. He is now associated with Guru and Jana Chartered Accountants, heading the NGO division of the firm and handling various works like valuations, overseas direct investments, ERP implementations, handling strategic growth initiatives of the firm, firm's quality assurance programs, writing of publications of ICAI, etc. He has co-authored a couple of sector-specific ICAI technical guides on internal audit as well. He has given multiple practical training sessions to the students in the past and helped them bridge the gap between theoretical knowledge and practical knowledge. So here we have, ladies and gentlemen, CA Kaushik Raghunandan as the speaker for day 3 audit session, tax audit session. So let's all welcome him. Over to you, sir.
Thank you for the brief introduction, Hannah Mukesh. I would like to thank our chairman and vice chairman for giving me this opportunity to present here today for the SICASA sessions. So before we start today, as I know this is the third session that we are taking today. So before we start, I would like to tell that this session has to be very interactive. Suppose the session is interactive, then we can get to know how what is your thoughts, or are you able to understand or not, and things like that. And secondly, when you have any questions, feel free to post it in chat box. We'll try to answer them as and when possible. So let us start with a little revision. So I'll open the chat box. I will request all of you to say what you learned in the past 2 sessions. I would request all the participants to just write a line like what you have learned in the past 2 sessions. Rashmi is telling something. Can you please tell, madam? I would request the participants to write something in the chat box so that we can start. Yes, John is telling that we learned clauses 20 to 27. That's nice. I would request others also to respond. Atul is waving his hands. Yes, presumptive schemes. That's nice. Okay, so let us start with the session. Tax audit is applicable to which type of entities, all that is covered, I believe. So now we are in the second part of the tax audit report, that is 3CD, part B. So in part B also 1 to 8 clauses is already dealt with. So now let us start with clauses 9 to 20. So what is your objectives? Why we should why this session? The objective is to understand the tax audit report clauses. See, there are various clauses in the tax audit report. First, we should get an understanding of what they are asking. So to get the clarity of what is being asked, where to get the information, now how to fill that, and what is this our source of information, those things we have to know, and what documentations to maintain. So every clause where we are writing some data, so in support of that, what documentations are we maintaining is the question. Then how do we fill the data? We have got all the data, how do we fill it? And if there is any practical challenges, we can discuss that. So this is our basic source of documents. Source of documents is our books of accounts, bank statements, AIS statements, GST portal, and TDS returns, and so on and so forth. So from all, this is our source of all the information. So from this, we are collating all the information, and we are trying to fill the tax audit report from clauses 1 to 44. So the first clause for our discussion today is clause 9, profit sharing ratio. So if you see here, they are telling that there are two subclauses under this, clause A and clause B. So first they are telling if the firm or association of person indicates the name of partners, members, and their profit sharing ratios. So what does this mean? So if it is a firm or AOP, only then this clause is applicable. Is it correct or not? Suppose I am a private limited company. Should I have to start with, should I have to fill this clause? Can you please answer in the chat box? Yes, John is telling it is not necessary. That's right. So this clause is applicable only if it is a firm or AOP. And what should we give here? We should give the name of the partners or members and their profit sharing ratio. If you see the example below, in our case, it is Satnarayan Murthy who is having 50% share in the partnership firm, and Suma Murthy who is having another 50% share in the partnership firm. So in this way, we need to disclose the name of the partners and their profit sharing ratio. So this is about the clause 1. What does the clause 2 deal with? If there is a change in partner or members, or there is a change in profit sharing ratio since the last date of preceding year, particulars of such change. So what are we asking here? They're asking if there is a change in the partners. So suppose there is a new partner admission. So then we have to, then this clause gets triggered. Suppose there is a deletion in the partner, then this clause again gets triggered. Or what happens if there is an addition of a member in case of an AOP or deletion of a member in case of an AOP, then also this clause gets triggered. And in what other situation this gets triggered? If there is a change in profit sharing ratio, also this clause gets triggered. So whenever, suppose Satyanarayan Murthy is willing to take 75% and Suma is taking 25%, even then this clause gets triggered and we need to do the reporting under this clause. So let's go to the next slide and see how it works. So change in profit ratio, member, partner, members or partners. So in this case, Satnarayan Murthy is having 40%. So this also should get disclosed. Suma Murthy is getting 40% change in ratio, therefore it should get disclosed. And Sohan Murthy, he is getting 20%. So therefore he is a new addition. Before in the previous slide, he was not there. In the present slide, he has come. So he is an admission. So when there is an admission of a partner, we need to give the details of such new partner and the profit sharing ratio. Is it clear? Can you all respond in the chat box? Is this clear? Yes. So everybody is telling yes, yes. So let us take an example. Now, in case of now there is a new situation. Suppose Satyanarayan Murthy is willing to retire now. Will the clause get triggered? Yes or no? Suppose Satyanarayan Murthy is retiring. Will this clause get triggered? Shivani is telling yes. John is telling yes. Because change in partnership, Ramesh. Bhanu, yes. Yes, all of you are right. So whenever there is a change in a partner or change in a member of an AOP or there is a change in profit sharing ratio, in any of these cases, then this clause B gets triggered. So we need to report it. So I hope this clause is clear. So let's go to the next clause. So here clause 10 is talking about nature of business. So what is this? Here also there are two clauses. So the first clause is nature of business or profession. If more than one business or profession is carried on during the previous year, nature of every business or profession. So what they are telling here, you have to disclose your nature of business they are telling. And what if it is multiple business? If it is multiple business, then we have to disclose all of them. For example, we are having a retail in the same retail store, we sell some products in a wholesale basis. So in that case, we need to disclose retail sale of certain product and wholesale sale of another product. So in this way, we need to disclose all the nature of business in this clause. Now, what does the clause B say? If there is any change in nature of business or profession, particulars of such change should be disclosed here. So what is this change in nature of business? Suppose I was a retailer all this while, and now I have become a wholesaler. Then we have to give the disclosure of such details in this clause B. So now why is it important? As you can see the slide here, one of the reason is the net profit ratio is different for different industries and different type of expenses will be there for different type of businesses. So the department does not know what nature of business you are doing means they will not be able to assess whether your profits are right, whether it is in the proper range or not. They'll not be able to ascertain. Therefore, we have to disclose our nature of business. And suppose there is a change in future, we have to disclose that change as well. Any doubts here? Can you all tell me any other reasons why this is important? What could be the other reasons why this change in nature of business is needed? You can answer in the chat box. What could be the reasons? You can give your guesses. So John is telling change in business can have huge tax implication changes. Can you explain, John, in what way?
Sir, like you've already mentioned, different business industries will have different nature of expenses, and some business might have inventories, some business might not have inventories. The way the
Very
business
good.
works, everything will change, ultimately resulting in changes in profits and the tax implications. That's what
Very
I
correct. Very correct. So John's point of view is that some businesses may have inventories, some business may not have inventories. Some business may have good profits, some business may not have good profits. In a wholesaler business, there could be a profit margin of 5 to 10%. But in case of a retail, the profit margin could be somewhere 15 to 20%. So it completely changes when the nature of business itself changes. Suppose all this while you were a business trader. Now suddenly you qualified as a chartered accountant. Now your nature of business completely changed. You're a chartered accountant now. So this kind of business, whenever there is a change, it is very important for us to disclose. And only with that information, the department will be able to assess our taxes. So as I told you earlier, so let us see the example. Before we were a wholesaler in this example. So when we were a wholesaler, you can see here our products is completely in cartoon boxes. It will be shipped to different cities, different states, and things like that. So here you will not see any customers coming into the shop. It will be all through emails, phone calls, or through website and things like that. In the second case, When you come to a retail store, when we change our business to a retail model, there'll be a lot of customer inflows to into our shop. Our shop's location may change. We may have to put our shop in a prominent place of business, very accessible to the general public and things like that. We have to showcase the products like this, unlike the cartoon boxes and things like that. So the complete nature of business itself has changed here. In a previous example, in the wholesale category, our major expense could be loading and unloading charges, packaging charges, and things like that. But in the new shop, in the retail entity, our major expense could be our shop rent, because there could be a phenomenal shift in the shop rent. And what else could be there? There could be a lot of more manpower who will be in the shop, who will be like a cashier may be needed, a person who can do the billing, and then the person who can do the packing and things like that, maintaining the stocks, replacing the stock, and things like this. So the whole nature gets changed, nature of expenses gets changed, nature of the amount of profits will change, the volume will change, many things like this. So it is very important for us to note the changes here. Yes, John is also telling TDS and TCS applicability also gets changed. So that is also true. Suppose you are in a service industry, now you are moving to goods industry, means your completely your TDS provisions will change. In the sense that the applicability will be different to you. All this while you could be having salaried employees alone in case of a retail store. But once you go to a service industry, you may have to employ a lot of consultants, you may have to pay commissions and things like that. So the nature will completely change. Any doubt on this clause? You can say yes or no in the chat box. Thank you. So the next clause is list of books of accounts that is prescribed, maintained, and examined. So here books of accounts, whenever we say the books of accounts has been prescribed under section 44 AE. So they will tell list of books that we have to maintain. So that prescribed is what is needed, what the act says that we have to maintain. And the second thing is where we have maintained, whether we have maintained all of them or not. The list of books that we have maintained, that list we have to give it. And suppose you are having multiple places, it is multiple locations where you're operating your business. Say your centralized expenses could be in location one, but your sales centers can be in multiple locations. So in that cases, list of books maintained at each location also needs to be disclosed. Say for example, you're having a store in Bangalore in our Baswangudi as our head office, and you're having stores across Whitefield, Malleshwaram, Electronic City, and etc. So in Whitefield, Electronic City, and Malleshwaram, you may have to maintain your cash related books, where if you are having cash sales and things like that, you may have to maintain your sales register. Suppose you are doing a centralized purchases, then the Baswangudi office will procure it and send it across to you. So purchases will not be there. Only a stock register needs to be maintained, and so on and so forth. So like this, suppose you're having multiple locations, and in each location what books of accounts have been maintained has to be disclosed here. And the last point is very important: what books you have examined, that information also should be disclosed in this clause. Is it clear? Srivatsa has any doubts in the previous slide? Okay, Srivatsa. So yesterday you might have discussed about the, sorry, anybody has doubts? Okay. So yesterday you might have already discussed about this presumptive profit details. So what is this presumptive profits? Can you please answer in the chat box? What is presumptive profits? Minimum profits presumed by the tax department. That's right. So whenever you are doing certain type of business, and suppose that business, there is a specified section dealing with that business, then whatever percentage has been mentioned in that business, so much percentage will be your presumed profits. That will be your minimum profits. Is it necessary that it is your maximum profits? Will it be your maximum profits or it is your minimum profits? Kushi is telling it is minimum. That's right, Kushi. So whenever there is a section that is there, that section prescribes only a minimum profits. So that minimum profits related only will be offered to taxes. Suppose you have got a higher profits, then you can disclose the same and offer it to the taxes. So now what is that is coming here? When you do the presumptive profit provisions, is it necessary? Is it needed for you to come to this tax audit provisions? All this while our understanding is that if I am under presumptive profits, tax audit is not applicable to me. True or not? Yes or no? You can respond in the chat box. The general understanding is that if we are going under presumptive taxation, then tax audit is not applicable to us. This is not true because there are certain businesses which for which the presumptive taxation will be applicable, and for certain type of business, presumptive taxation may not be applicable. So where the presumptive taxation is not applicable, there the general thresholds of 1 crore will come into the picture. So in those cases, suppose the 1 crore threshold is crossed, then we have to do the tax audit. While doing the tax audit also, they may have certain businesses which is under the presumptive taxation. So in those cases, we have to declare what is the profit that we have earned from the presumptive business. So this clause is talking about those details. So let us read what does it ask for. Whether the profit and loss account includes any profits and gains accessible on presumptive basis. So whatever this profit and loss is there, no, does it include any this whatever you are showing in your profit and loss account? That profit and loss account, whether it includes any profits or losses on account of presumptive basis, they are asking. So if it is yes, then we have to indicate the relevant section under which that profit is there, and we have to write the profit that we have earned. So this is what this clause is asking about. Is it clear? Any doubts here? Any doubts here? Very good. If an assessee does a business which is accessible to taxes on a presumptive basis, profit under such section should be disclosed separately here. So that amount we have to disclose it separately. If there is no books maintained for such additional business, see now you are for tax audit you have to maintain books of accounts. Yes or no? If you are covered under tax audit, you have to maintain books of accounts. Yes, that's right. So when you are maintaining books of accounts for certain transactions, and for certain transactions, you have not maintained books of accounts. Why you have not maintained books of accounts? Is it allowed not to maintain books of accounts? What does the presumptive taxation section say? John is telling it is not mandatory. That's right. So with the presumptive taxation sections, most of the sections says that suppose you are coming under the presumptive taxation category, then you need not maintain books of accounts. So now suppose our main business is into retailing, and some business we have got from some shipping activities. So for shipping activities, there is a presumptive taxation applicable. So now for this shipping business, I don't have to maintain books of accounts. So that additional income is coming, right? So for that, I am not maintaining books of accounts. So in this situation, what should I do? So then the auditor should satisfy himself on the correctness of the net income. So whatever net income they are showing there, we have to get satisfied that that amount is right or wrong. Suppose it is not right as per our view or as per our opinion, then we can mention the same thing under this clause. Suppose they are maintaining separate books of accounts. What is the scenario then? What is the scenario if they are maintaining separate books of accounts? Then there is no issue, right? Suppose they are maintaining books of accounts, then there is no issue because we'll know what is our income, what is our expenses, and things like that, so that it will be easy for us to determine what is the profit that they are disclosing. So then it will be an easy work for us. Suppose they are not maintaining only, we should be worried and we should satisfy ourselves with the correctness of the net income. Any doubts so far, so forth? So John and Banu, only two people are responding. What about others? Everybody is there in the session, right? Yes, Atul is responding. What about others? I want to see more responses. Hemant, no. Shivatsa, no.
Hello,
Yes. Shivani, no. Good. So let's proceed. Method of accounting. So this clause 13 is a very important clause. There are various aspects discussed under this clause. So let us understand that in detail. Whether cash method or mercantile method. So what is the method of accounting that we are maintaining? Whether it is cash method or mercantile method. So they are giving us two options here. So what is this cash method? Any guess? Can anybody answer what is cash method of accounting? Can answer it. In your words, no issues. John says accounting actual receipts and payments. That is right. Receipts and payment based accounting. Bhanu says that is also right. So cash method means to say that it is all whatever is impacting our cash book or the bank book. So actual payments, whatever is there, only that gets accounted as expenses. Actual receipts, whatever is there, only that gets recorded as income or receipts. So in that way, the cash method of accounting is also allowed under Income Tax Act. Now, is it allowed for us to maintain cash method for in case of all types of assessees? What are the types of assessees do we have? Can you just name few types of assessees? Can write in the chat box. Individuals, HUFs, company, AOP. That's right, Shivani. HUF, AOP, BOI, partnership firm, company, etc. So let us take each scenario. So individual, can you maintain cash method? Viresh says partnership firm. So individual can maintain cash method. That's right. HUF. HUF can maintain, they are telling. What about partnership firms? Shivani says yes. So can a company maintain cash method? Private limited company. Can a private limited company maintain it? No, 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 no. All of you are answering no. Yes, that's right. So in case of a private limited company, they are not allowed to maintain cash method of accounting. They have to account it as in a mercantile method, that is accrual method. So in case of company alone, there is mercantile method. In all other cases, they have a choice of cash method or it is mercantile method. So the assessee can choose it. Yes or no? Agreed or not? Can we take a conclusion that in all other cases, assessee has a choice to select the method of accounting other than private limited company? You can say yes or no. Shivani says agreed. What about others? Bhanu says yes. That's right. Srivatsa says yes. So this principle we can carry it. So in case of private limited company, they have only one choice, that is mercantile method. In all other cases, they have a choice of cash method or mercantile method. So now what is mercantile method? We understood what is cash method. What is mercantile method? Accrual basis. That's right. What about others? So what do we do in accrual basis? What is the difference between the cash method and accrual method? Can you tell one principle, one example? Record even when cash is not received is what Srivatsa says. Accounting even if the transaction has not actually happened. Accrual payments are recorded even not paid. So let us take an example now. So now I sold a product. I sold say iPhone. I sold an iPhone to say Hemant. So now Hemant is paying me money of 1 lakh rupees for the iPhone. So in cash method of accounting, when I sell it and Hemant gives me money, at the point of receiving the money, the sale will be recorded. Yes or no? In case of cash method, when Hemant gives me money, I'll be recording it as sales. Yes, everybody is agreeing to the point. That's right. So let us take another example. Now I have sold the product to Hemant. Hemant has agreed to pay me in a future date. Say he has agreed to pay me on October 15th. So is it a sale? Is it a sale? First question is it a sale? Yes, it is a sale. Now, should we record it in case of accrual system? Yes, yes, yes. That is what we are getting the answers. Why we have to record it? Because in case of accrual systems, whenever there is a promise by the debtor that he will make the payment in a future date, and in that scenario, we will record the sale because we are in the accrual system of accounting. So in the accrual system of accounting, as and when the income is accrued, when is my income accrued? I'm making the sale today. The risk and reward of that product is getting transferred to Heyman today. So therefore, I have to account my income today. So that is the method in which the accrual system will work. Suppose I have to have an expenditure. Let us take an example of expenditure. So in this expenditure, I am having a situation where I have to make the payment today. So in case of cash method, I'll be accounting it today itself since the payment is going out. In case of accrual system, I'll make the payment say on October 10th. Should I have to account it? Should I have to account if the payment is being made on 10th of October? Yes or no? Yes. Why? Because whenever we have incurred the expenditure, the risk and reward of the benefit of that expense, we have already consumed it. When the risk and reward get transferred, we have to account it under the accrual system. So this is about the cash method and the accrual method. So now what is being asked in this case? So in this clause, what they are asking is which method of accounting are we following? So our client, are they following mercantile method or are they following cash method is what they are asking. So in case it is a cash method, you have to answer it as cash method. In case it is under mercantile method, you have to answer it as mercantile method. So now you have got an understanding how to differentiate what is a cash method, what is a mercantile method. So now you should be able to answer the first question. Now, what is the second question? Whether there is any change in method of accounting. What does it mean? Can you answer in the chat box? Whether there is any change in method of accounting. What does it mean? Shifting from one method to another method is what Srivatsa says. That's right, Srivatsa. So now when we are following cash method and in a year, suppose we have decided to move from cash method to mercantile method. So then the second clause gets triggered. So switching from cash to accrual or accrual to cash, whenever this thing happens, then we have to report here. So whether there is any change in method of accounting, we have to answer yes in that scenario. Suppose there is no change in method of accounting, we are following constantly the same thing, then we need not answer anything for the second one. It will be not applicable. Is there any change in method of accounting? Then we need to disclose the effect of change on the profit and losses. So what does this mean? They're asking us if there is a change in method of accounting, what is the impact of that change of method of accounting on the profit or loss they are asking here. So let us take an example. In cash method of accounting, I was following all the while. Now suddenly I have changed to mercantile method. So in cash method, suppose my revenues I had rendered a service of, for example, 1 crore. But I have received only 50 lakhs. So in the previous year, I was following a cash method. In the previous year, my receipts was 50 lakh rupees. So I had followed the cash method of accounting and I had offered taxes of only 50 lakh rupees as profits in my in my IT return. Is it right? So now in the year 2, I have moved from cash method to mercantile method. So in this year also, I have rendered a service of 1.2 crores. Now in this year, I got the balance 50 lakhs also. Now in this year, what should be my profits? How much should I disclose? You can answer in your chat box. Bhanu Prakash says I have to disclose 1.2 crores. Shivani says I have to disclose 1.2 crores. Hemant says 1.2 crores. So since I have changed my method of accounting, I have to disclose 1.2 crores as per the new method of accrual system. I have to show 2 crores, 1.2 crores as my profits. So this is right. Now what about the previous year's 50 lakhs that I have received in the current year? Should I have to disclose that as income in the current year or not? Can you answer? Should I have to add 50 lakhs to my income? Yes or no? No idea. But you see that there is a chance of income leakage. Yes or no? That's right. So there could be chances of income leakage to the government. Therefore, what government is asking is whenever there is a change in method of accounting, you need to disclose What is the effect of that change of method on your profit and losses is what they are asking. So by asking in this way, they are trying to bring to the ambit even that 50 lakh rupees which was not taxed earlier in the previous year. So is it clear why? What is the purpose of asking this question? Yes. So whenever there is a change of method of accounting, it could lead to situations like this. It could be the reverse also. You might have received some funds in the if you are following mercantile method and in the cash method you have switched it. Suppose your income has to be so X number, it can be reduced as well. So it depends, and therefore they're asking what is the impact or effect of that on the your profit and loss account. Is it clear? Can we go to the next slide? Okay. So now what is this? Books are here and ICDS. What is this ICDS? Income Computation Disclosure Standards. So what is this? Why is the income tax department telling you to do this income ICDS, income tax disclosure standard, income computation and disclosure standards? John has a doubt. What is that doubt, John?
Sir, in the previous example, you have mentioned 50 lakhs on which we have to pay tax, right?
Mm-hmm.
So, on which rate the tax would be payable? For example, in the last year, one tax rate is there, and in the next year, there is a revision in tax rate or something like that.
It should ideally be the current year taxes.
Okay, okay, sir. Because it
So,
is received on that year, so we are following that tax rate.
because the change of my method of accounting happened in the current year.
Okay, okay, sir.
Since the
Thank you.
change has happened in the current year, the effect of that change should be brought to the tax ambit in the current year.
Okay, sir. That makes more sense actually.
Yeah.
Yeah.
Okay, so coming to ICDS, what is this ICDS? When we have accounting standards, why should we maintain, why should we follow this ICDS? We already know that we have got a lot of accounting standards that is there. Is it applicable to all of us? Is accounting standards applicable for all? John says it is not applicable. What about others? Is an accounting standard applicable even to an individual partnership firm? HUFs? Shivani says it is not applicable to all the assessees. So income tax, the accounting standards, whatever the institute has released it, it depends, it is not universally applicable to all the assessees. It depends and differs for each type of assessee. So therefore, there is no uniformity in the method of accounting, or the accounting standards is not there. So if there is no accounting standards, there is no uniformity established. So when there is no uniformity established, there is chance of ambiguity. A person can disclose his books of accounts in a certain way. Another person can disclose his books of accounts in a certain other way. So there's no uniformity. To bring uniformity among all the income tax assessees for whom accounting standards is applicable or accounting standards is not applicable or may not be applicable, for all the people in general, they brought in this income disclosure, income computation and disclosure standards. So this talks about few areas. So there are 10 ICDs which has been released by the income tax department. It is applicable only if the mercantile method of accounting is followed. So in the previous slide, what did we discuss? Whether cash method or mercantile method of accounting. Suppose you're falling under the cash method of accounting, then ICDS is not applicable to you. Suppose you're following mercantile method, only then this ICDS is applicable to you. Is it clear? Is this point clear? Because this is very important for us to go further. Yes. Everybody is telling they have understood it. Applicable only if these are applicable only for income computation and not for maintenance of books of accounts. See, this is another important aspect. So this is not for maintenance of books of accounts. See, if you see accounting standards should be used while maintaining books of accounts. So while maintaining books of accounts, accounting standards should be used and it should be followed. But ICDS is not like that. ICDS is only for the purpose of computing your incomes. It is not for the purpose of maintaining your books of accounts. You may maintain your books of accounts not in consistence with the ICDS. But while doing your income tax computation, you have to follow it and make it right as per the income tax requirements. Is this clear? It is very important for us to understand it because only for income computation these standards are applicable. But for maintenance of books of accounts, the assessee may maintain his own method, his own way of maintaining the books also. So whenever this cash method of accounting is followed, then clause DEF is not applicable to the assessee since they follow the cash method. So in clause 30, there are 6 subclauses. So first 3 clauses talks about method of accounting, whether there is any change and effect of change. The next 3 clauses talks about the ICDS related disclosures. So when you follow a cash method of accounting, then the next subsequent 3 clauses are not applicable to you at all. Is it clear? Very good. Disclosure as per ICDS to be included in the tax audit report under clause F. So in this clause F, whatever disclosures that we are, the ICDS prescribes certain disclosures to be made. So what all disclosures it is prescribing us to do. So those disclosures we should do it under clause F. That is what this point talks about. Let's go to the next slide. See here. Whether any adjustment is required to be done to profit and loss for complying with ICDS. If you see, clause D is talking about this. See, now you have maintained your books of accounts in a certain way. Whether there should be any adjustments to that profits, whatever you have computed, to arrive at the profits as per ICDS is what they are asking. So in certain cases, what happens? You have maintained your books of accounts in a certain way. But ICDS tells that you have to maintain it in a as per ICDS format or as per ICDS methods. We'll see the examples in next slides. So it is telling in a different way that you have to maintain your, you have to compute your income, you have to compute your incomes. So in such scenario, you have to disclose every ICDS like this here in the left picture. You have to tell what is the ICDS name and as an impact of that, whether your profit is increasing or your profit is decreasing and what is the net effect on account of that ICDS they are asking. So this table needs to be filled by us in the tax audit report. So wherever there is a deviation, from the perspective of ICDS, in such situations, what is the impact of the deviation, whether it will increase my profits or decrease my profits, and what is the net impact of that as per that on account of that ICDS, and should I add it to my general profits or I should reduce it to my general profits? This is what is being asked in this clause. Is it clear? Are you able to understand? Very good. So let us take a few examples and understand it. So examples of what should be added, what should not be added. So ICDS 1 prohibits recognition of expected losses or market losses. See, generally accounting standards says a concept of prudence. Yes or no? What is prudence? What is prudence concept? Any idea? obvious is provide for future losses, provide maximum loss and minimum profit. John says anticipate only future losses, Hemant says. So all these are right. So in the general accounting parlance, as per the accounting standards, we have to follow the prudence concept. So if we are expecting any losses in future, then we should provide that immediately. That is what the accounting standard generally says. But here, if you see ICDS, it is not in the same line. It is having a different opinion. So what are they telling? It prohibits recognition of expected losses. Though you feel that there could be a loss in future, don't provide for it, it is telling. So in the year in which you are incurring losses, let me take that only in the year in which that loss is incurred is what they are telling. Why do they do that? Two reasons. One is government wants more taxes. So if this expected provisions you make it in your books of accounts, then the profits will reduce. When profit reduces, the taxes also reduces. So that is the first reason. The government will earn lesser revenue. So it is a pro-government ICDS, we can say. And what is the second reason? The government is of the view that it may or may not be incurred in the future also. You are just providing for it. No, in future, suppose the loss is only not there means the government is of the view that let it come, that time we will account it. So in that way, the ICDS is having one view, the accounting standard is having another view. So when such a scenario happens, then we have to do the adjustments. So this is a deviation from the ICDS, yes or no? So when there is a deviation from the ICDS, we have to adjust so much to the profits that we have arrived as per the books, and we have to reduce or add it back as applicable. So let us see another example. Revenue recognitions. So in revenue recognitions, in case of a service contract, ICDS allows only percentage completion method, whereas accounting standards allows percentage completion as well as completed service contract method. So if you're following just accounting standards, you can also go to the completed service contract method. But the ICDS does not allow it. Is it clear? What happens if it is a completed service contract? Suppose the contract is for say 2 years. And as per the accounting standards, you will recognize the revenue only after completion of the service, yes or no? So when it gets completed, it will get completed in the next year. So when it gets completed in the next year, you will offer that amount to taxes only in the next year and you will pay tax only in the next year. Yes or no? Yes or no? You can answer in the box. So you will offer it to taxes only in the year in which your service is getting completed. So service is completed, getting completed in year 2 means you will offer that income to taxes in year 2 and you will pay taxes in year 2. So in year 1, you will not offer any profits. So government is again losing revenue, yes or no? That's why government is of the view that you have to follow only percentage completion method. Suppose you have completed 50% in the current year, show 50% of your incomes in the current year and pay taxes on the same is what is their view. Is it clear? In construction contracts, A7 requires a provision to be made for expected losses on onerous contracts, construction contracts immediately on signing the contract. Under ICDS 3, losses incurred on a contract shall be allowed only in proportion to the stage of completion. So again, they are deferring the booking of losses. So in the when you know that you are accepting a project which has got loss, then what is the accounting standard says? You book the losses in the year in which you accept the project itself, they are telling. But what is ICDS telling? You do it proportionately, it is telling. In year 1, you do proportionate profit, whatever the amount is there, completion is there. As per that, you book the loss. In the year 2, again, as per that percentage, you book the loss. In year 3, also similarly. So this is what they are telling. So what they are trying to do, this it is same like the first point. So prohibits recognition of expected losses. So it is not allowing you to recognize that loss at all. Is it clear? Any doubts here?
Sir, I have a doubt.
Yes, John.
So in the first point, mark to market losses, it is there, no, sir. So in
Yes.
some cases, like NBFCs or banking companies, how ICDS applicability will be there, whether it is applicable or only for the entities governed by Companies Act.
See, this is applicable to all the entities. That is what we saw in the previous slides. Whoever is following mercantile method, for all of them, this is applicable. Further, there is a technical guide also on this ICDS. We can refer this guide to see whether it is applicable for NBFCs or not in particular.
Okay, sir. Got it.
So one thing is the government has released the notifications in this regard. So in that notification, it is telling for whom it is applicable. So generally, it is applicable for all the entities which is following mercantile system. And further, we can see the NBFC point in this guide. Is it clear? Can we go to the next slides? So
Yes, sir.
all of you should read this technical guide once. So wherever you have got any doubts, say, John got a doubt like whether it is applicable for NBFC or not. So you may have different type of doubts. You may be encountering different situations in your office. So in such a scenario, you can refer this guide. You can see what is applicable, what is not applicable. Secondly, what has to be disclosed also is very important here, because one of the point that we discussed here is disclosure as per ICDS to be included in the tax audit report under clause F is what they are telling. So what all should be disclosed is also disclosed in this technical guide. So in case of revenue recognition ICDS, they are telling that you have to recognize what is the revenue that you have earned out of services, what is the revenue out of goods, what is your if it is percentage completion method you're following or not. Like this, every standard is telling that you have to do certain disclosures. So all those disclosures, whether we are doing or not, whether what has to be disclosed, all those things you can read this technical guide and get and understand. Is it clear? Can we go to the next slide? Any doubts? Very good. So let us go to the next topic, which is closing stock valuation. So this is a very important clause, and secondly, there is a lot of debate on this clause. So let us see all of that in detail now, but let us see what the basic clause is asking. Method of valuation of closing stock, lower of cost or NRV. So they are asking us to value the closing stock. And how we have to value, they are asking. Whether you will value it in cost basis or NRV, they are asking. And the point that we have to take it here is only cost is not allowed, only NRV is not allowed. So what is in Income Tax Act specifying is it is asking us to follow that method, which is a comparison of cost and NRV. So whatever is lower out of this two, that we have to adopt it. Based on that method, we have to value all of our closing stock. Is it clear? Method of valuation of closing stock is lower of cost or NRV. Is it clear now? Any doubts here? Yes, both of you have told there is no doubt. Adjustment to closing stock if there is any deviation with section 145A. So we have to read this section first before understanding what is this deviations. So let us see that. See the first point. The purpose of determining the income chargeable under the head profit and gains of business or profession for the purpose of determining the income. So for the purpose of determining the income, what should be considered? These 4 points should be considered. The valuation of inventory, as we discussed, it should be done based on lower of actual cost or NRV. This is clear. So let us go to the next point. In valuation of purchase and sale of goods or services and inventory shall be adjusted to include amount of any tax, duty, cess, or fee actually paid or incurred by the assessee to bring the goods or services to the place of its location condition as on the date of valuation. So what they're telling here is you have to add the taxes, duties, cess, fees, whatever may be the name. All these things you should add it to purchases, you should add it to your sales also. So what they are telling here, they are not talking only about the inventory here. They are talking about the purchase and sales as well here. But our clause was dealing only with respect to valuation of inventory. But the second clause, whatever we discussed there, was in relation to any deviation in the method of accounting as per section 145A. So what happens generally? What happens in the client's books of accounts is we will account it on an exclusive basis. So what is exclusive basis? Suppose my product, say iPhone, which I have purchased from the dealer, from the wholesaler, is 1 lakh rupees. GST on that is 18,000 rupees. So my price that I have paid to my vendor is 1 lakh 18,000 rupees. So generally what happens, we'll account only 1 lakh as our expense in the profit and loss account. Yes or no? Generally, we account it as 1 lakh. Yes or no? 1 lakh gets impacted to the profit and loss account. 18,000 goes and sits in the input tax credit ledger in the balance sheet. Is it clear? Is this right? So generally we do that. But there is also another method of accounting where we will we will also account the related tax and duty, everything in the profit and loss account itself. So that is what they are telling here. They are talking about here. So whenever there is a purchase or sale, the related taxes, duties, cess or fee, whatever is there, that should get added here. So my amount that gets impacted my profit and loss account when I purchase that iPhone is 1 lakh 18,000 rupees and not 1 lakh rupees. Is it clear? Is it clear here? This section is asking us to do the accounting at 1 lakh 18,000 directly to profit and loss account. Yes. So that is what they're asking here. At the time of sale, what happens? Suppose I'm selling at same 1 lakh rupees, for example. I'll have to account the sale as 1 lakh 18,000 rupees in the uh, credit side of the profit and loss account as my sales. Yes or no? So in this way, they are asking us to add the taxes also with the sale price and purchase price. So in this way, they are asking us to maintain the books of accounts for the purpose of determining the income, valuation of purchase or sale of goods and inventory. See, they have brought in the inventory as well here. Inventory shall be adjusted to include amount of any tax, duties, cess or fees, anything. So like in this way, they are asking us to add all of this. But generally we don't do it, right? Generally when we don't do it, this section is asking us to do the addition of these items to our stock items. Only then we should do the valuation is what they are telling. Is it clear here? Is it clear? Is the intent of the section clear? They're asking us to put the indirect taxes, that is the GST, also into the profit and loss account and do the accounting they are telling. So in this way, when we do the accounting, only then it is proper. If not, what will happen? So we are coming in the if not category. Adjustment to closing stock if there is any deviation with the section 145A. So in our closing stock, is the taxes included? Yes or no? In my closing stock of that one, suppose I have purchased it, I have not sold it. So what should be my value in the general balance, not in the as per the section 145A? What should be my price, 1 lakh or 1.18 lakhs? You can answer in the chat box. Then what will impact your profit and loss account? 1 lakh or 1.18 lakh? Usually it's 1 lakh, 1 lakh, 1 lakh. Yes, others? Others, what is your view? What is your opinion? Atul says 1 lakh. How about others? So we will be valuing our stock at 1 lakh rupees only. So there is a deviation in this case. Yes or no? Since we are accounting at 1 lakh rupees without taxes, there is a deviation here. So since there is a deviation, we have to add the taxes, a duty, cess on purchase and sale of goods and services. So whatever is the tax on that purchase, that 18,000 rupees, I have to add it. That is what this clause is talking about. Is it clear? Yes, all of you are clear. So now what happens? Now we don't generally do this. Yes or no? We generally do not add or do anything. I hope there are a lot of seniors also in this group. So what do you generally see in the tax audit reports? Do you see any adjustments being done in clause 14? You can answer in your chat box. This is for the seniors who are there in this group who have seen the tax audit reports. Some entities, some CAs are doing this, some CAs are not doing this. So some people who are doing this, they are taking a view that when my closing stock I'm adding it, even in my opening stock, the same additions I have to do. So whatever additions I'm doing in my opening stock, the same additions more or less will be the additions in my closing stock as well. When the same amounts is it's coming like similarly, then there is no need to do this adjustment is what many of the CAs have taken the opinion or taken the view. So it depends in your office what stand you will be taking. You have to talk to your seniors, your respective principals, and take a decision on that. So suppose your principal says that we'll do this adjustments means we'll do it. Otherwise, we'll not do it. So let me give you an example how it works. So what we can do is we can refer to the guidance note of the tax audit. So in guidance note of the tax audit, they have given multiple examples to us. So in that multiple examples, what they have considered is the effect of that will be nil, they have shown. So when you establish that the effect of the taxes on both your closing stock and opening stock is nil, then you need not do any type of adjustments. Let us see those examples once. See here, in a trading concern, the associate has opening stock of 3,30,000 on which input tax rebate is 30,000 that is available. So the rate became 3.3 lakhs here. During the three items purchased for 3 lakh rupees, VAT on the same is 10%. There is no opening stock. Two items sold at 4.5 lakhs and there is no VAT on the sale is 10%. You can see here increase in VAT, increase in opening stock on inclusion of VAT is 30,000. Increase in purchase of inclusion of VAT is 90,000. Increase in sale on inclusion of VAT is 90,000. Increase in closing stock on inclusion of VAT is 60,000. VAT paid on sales is 90,000. VAT credit availed on cost of goods sold is 60,000. So they are telling that the net impact on the profit and loss account is nil. So basically what they have done here, they have added the taxes for each of the aspect here. For each of the aspects, see, this is exclusive method, this is inclusive method. So in the exclusive method, they have taken without taxes. In the inclusive method, they have taken including taxes as the amount here. Purchase, you can see here. 3.3 lakhs is considered here. Here it is 3 lakhs alone. So in this way, they have done this computation. They have also calculated the impact of that. So the impact of considering being in inclusive method or being in exclusive method, they are telling the impact is nil. So in this way, certain few CAs have taken a view that though all of this is there, they are asking us to do it in an inclusive method, but still we will follow the exclusive method and do not do any adjustments, because we have made it certain examples, and we are of the view and opinion that it will not impact our profit and loss majorly. So that is why we are taking that decision, and we are not doing any adjustments to the profit and loss account. Is this class clear now? Are you able to see the screen? Closing stock valuation. Is it clear? John says it is clear. Bhanu Prakash says yes, sir. What about others? Any doubt here? Because this is an important thing that you should know, and you should know why you are not giving any impact also. Srivatsa, you have a doubt? You're not able to understand it? Okay, you don't have a doubt. I hope it is clear. So let's proceed to the next slide. So the next slide is about conversion of capital asset to stock in trade. So what happens, sometimes your capital asset gets converted into stock in trade. Example, I can give you an example. You had a computer in your office. Usually you use it as a capital asset. But one fine day you decided that let me not use this capital asset and let me sell it. So 5 to 10 computers, you started selling them. So in such scenario, we call it as conversion of capital asset into stock in trade. Another example could be you had a land and building as your capital asset. One fine day you decided that let me sell that. Let me, in that office building, there are a lot of portions. Each portion you want to sell it as a flat to different customers or different people. So in that scenario also, my building became an inventory. It is a stock in trade for me now. So in such scenario also, this clause gets triggered. So there are various examples like this. So whenever such a scenario you see, where an asset is actually considered as a capital asset, which is there in your balance sheet, but due to some reason, they are about to sell it. So therefore, it has got converted into stock in trade. So in such a scenario, this clause gets triggered. What are they asking in this clause? Give the following particulars of the capital asset converted into stock in trade. Description of the capital asset. What is the description? Say it is building. So we'll give the description as building. What is the date of acquisition? When was a building acquisition? When was a building purchased? So you will tell, say for example, it was purchased somewhere in 2001. So we'll be putting that date here. Cost of acquisition. What was the purchase price of that building? Say it was 5 lakh rupees. So in this way, you will fill in all these details and amount at which the asset is converted into stock in trade. So I am converting it in the current financial year. The current financial year, I am converting it. And as on what date I have converted and what is the date on which it is getting converted, based on that, it becomes my inventory values. It will get converted from my stock, it will get converted from my capital asset to a stock. But we'll have to pay taxes. Income Tax Act has given a relaxation in these situations. Only when it gets sold, you have to pay taxes, they say. But date of conversion becomes important for the calculation purposes, because up to that date, it will be a capital gain, and after that, it will become a business gain. Is it clear? Is it clear? Are you able to understand this point? Everybody has understood it. Very good. So let us go to the next point. Amount not credited to profit and loss account. Amount not credited to profit and loss account being the amounts falling within the scope of section 28. Sometimes what happens, some income you might have received it, which is actually income as per section 28, but it is not credited into your books of accounts. It is not there in the credit side of your profit and loss account. In such scenario, you have to add those amounts here. Can you give an example? I'll give you an example. You'll understand it. Then you can give other examples. Suppose this is a profit and loss account of a doctor. Doctor, during their course of profession, they have received certain benefits during the period. Say some travel tickets to a different destination. Say they have received some item which is in kind. So all these becomes a non-monetary item. So usually this will not be there in your profit and loss account as your incomes, because the money has not flown into the bank account, or it has not flown into your cash account. So therefore this will not be found. But you will have to disclose this and you will have to add it to this income. Is it clear? Is it clear? Okay, what is the next topic they are telling here? The pro forma credits, due drawbacks, refund of duty of customs or excise or service tax, or refund of sales tax or value added tax, where such credit drawbacks are admitted as due by authorities concerned. So whenever there is some duty drawback or benefit that you are getting it, usually you should account it as your income. So if it is not accounted, then we should bring it to the attention, and we should bring it in this point and add it to the incomes. Escalation claims accepted during the previous year. Suppose we are doing some construction contract. So in the construction contracts, in the year one, when we had decided the project value was say 10 lakh rupees. In the year two, due to the price fluctuations, increasing change in the prices and other things, raw materials and other things, there is an escalation clause in our agreement which says that the contract price also gets increased, say from 10 lakhs to 12 lakh rupees. So you are receiving 2 lakh rupees extra on account of escalation claims. So this 2 lakh rupees should be added to the clause 16C here. So this is what they're asking here. You cannot evade this from the taxes. You have to show it for taxes. That amount, whatever you're receiving it as an escalation, should be added here. That is what this clause is talking about. So what is this next one? Any other item of income. They have brought in an umbrella type provision here, or a residuary provision, I would say. So whatever is in the nature of income, which is not considered in above A, B, C, then you have to disclose it here. They are telling. So basically, it's a income, it's a profit, or it's a receipt for the PGBP, but it is not considered in the credit side. So in such scenarios, you will be adding up here. And what is the last one? Last one is a capital receipt, if any. So if there is any capital receipt that you have received in this financial year, then that amount should also be added here. So capital receipt is what? Which is not in revenue in nature. Suppose you have received some compensation for some project, or there is some lapses. On account of that, you have filed a case and you have received some compensation. This could be a capital receipt. So in such scenarios, what will happen? You have to add it to the profits here, they are telling. So whatever is a capital receipt, we should add it here. Is it clear? Can we go to the next slide? Before we go to the next slide, let us see the section 28 once and understand if something else also has to be added. So the first clause is pretty clear, PGBP from the business. Any compensation or other payments that is received by whatever name called managing or wholly or subsidiary or wholly or other affairs of the Indian company at or in connection with the termination of its management, modification, or the terms and conditions relating thereto. So if they have received any amount as a compensation due to changes in the terms and conditions in that amount, any person by whatever name called managing the whole or substantially whole of the affairs of the company or in connection with the termination of his office. So when he is leaving any office, if they are getting any money. So this is of this nature only. Let us see the next clause. Any income derived by the trade, profession, or similar association from specific services performed for its members. So if you have performed any services to your own members, then in that scenario also, whatever receipts you are getting, that income should be added there. Profit on sale of license granted under the import. This is basically sale of licenses that is granted. So we should add it to the PGBP. Any cash assistance that is received by the government, from the government. So if we have received any grants or any cash assistance, then you have to add it. This clause is important. This is what I told you. The value of any benefit or opposite arising from business or the exercise of any profession, whether convertible into money or not, in cash or in kind or partly in cash or in kind. So in this way, whatever you have received it, usually it will not hit the credit side of profit and loss account. In such scenario also, you have to value it and you have to add it up here. Any interest, salary, bonus, commission, remuneration received by whatever name or due or received by the partner. So partners related commission and other things here. So in this way, there are 7 clauses here. So whatever is there in this nature, if it is not added there, then we have to add it. I hope it is clear. Let's go to the next slide. This clause is in relation to sale of a land or building at a lower value. So clause 17, no, it says as 2 scenarios. When is it applicable basically? It is applicable when there is a sale. If there is no sale, this clause is not applicable at all. Applicable only if there is a sale of land or building. So basically there is a sale which has happened in the previous year. So in that case, this clause gets triggered. Then what happens? Applicable only if the sale value is less than the stamp value. Whenever you are making any sale for that property, usually there will be a stamp value which will be determined by the state government. So that value on the sale value, you will compare it. Suppose the sale value is more than the stamp value, then again this clause does not get triggered. Is it clear? Again, this point does not get triggered. Suppose when the sale value is less than the stamp value, then this clause gets triggered. This clause also gets triggered. When both of this clause gets triggered, then clause 17 reporting will be applicable. So what are they asking under this? They are asking details of the property, consideration received or accrued. So what is the value for which we are selling the property? Value adopted or assessed by the or assessable. So what is the value, stamp value that should be assessable? Whether provisions of section provisions to subsection 1 of section 43 or 4 proviso to 56 is applicable, yes or no. So whether these provisions are applicable, yes or no, they're asking. So for this, what details do you need? You need to obtain the sale deed. You need to obtain the sale deed from the client. Then you have to see what is the stamp value that is applicable right now. You can see that in the Kaveri website, or you can also get in a few books. From that, you will obtain what is the stamp value. Then you will do the comparison. After doing the comparison, if the value is less, then it gets triggered. You will fill in all these details. So there are 2 scenarios. Suppose it is not a capital asset. So we saw a situation where a building was there as inner capital assets. We converted that into stock in trade. we are selling it as flats or any other thing to our customers. So in that scenario, it is our inventory, right? So whenever it is in the inventory category, 43 CA gets triggered. Whenever it is in the asset category only, whenever it is as a building alone, in that scenario, it will be categorized as capital asset. So in both the scenarios, the similar provisions will be applicable. So whenever such things happens, then they will tell that the value has been shown less. So whatever is the stamp value, that becomes the sale price. Shortfall amount, whatever though we have not received it, we have to pay taxes for that. Similarly, the person who is receiving it, he is receiving it for a lower consideration, that property. So it is inevitably a gift, right? It is a gift under section 56. So that amount will be taxable to him as well as our client also. So in that way, this will have a dual impact. So here, when we disclose those things, the value, whatever is the shortfall, will get added to the incomes of the current year, and we will have to pay taxes. So in this way, we have to fill the table here. Is it clear? Any doubts here in this? Any doubts here? Can answer in the chat box. Yes, John says there is no doubt. Srivatsa, no doubt. Manu Chaudhary, no doubts. Okay, very good. So I hope this slide is pretty clear. So now it is a very rare clause. Only few cases you can see it as applicable. If it is applicable, if these two get satisfied, then fill in this table and see the valuations. So the next point is very important, that is depreciation. See, depreciation is a mandatory thing. If a company has got assets, if a assessee has got assets, then depreciation is mandatory. So when we are doing these depreciations, we have to keep in mind certain things. So what are those things? Whether classification of asset is done properly or not. This is a very important thing. Suppose you have bought a building and you have classified it as a plant and machinery. Is it okay? What impact will it have? What impact will it have? Suppose you have bought a building which has to be depreciated, say at 5%, and there's a plant and machinery which has to be depreciated at 40%, say computers. What happens if there is a classification mistake? You can answer in the chat box. Profit will be misstated. What happens? Profit will go down or go up? Profit will go down. So what happens if profit goes down? Taxes will be levied at a lesser rate. The taxes will be less to the government. So this has got similar impacts. So whenever classification is not done properly, then it is our duty to do the classifications properly and make it right. Suppose the classification goes wrong, then rate of tax also goes wrong. When rate of tax goes wrong, the profits may be misstated, which is understated or overstated. If profit is overstated, you are at a loss. If profit is understated, government is at a loss. So this kind of activity should not happen. So therefore, you should always keep in mind that we should do the classification properly. So you should see the related supporting documents. See, you will see the purchase voucher. You will see the land deed. You will see the computer means. Suppose it is a computer means you will see the invoice of the computer. Suppose it is furniture means you will see the invoice of the furniture. So in that way, you will satisfy what is the nature of asset, and based on that, you will do the classification, whether acquisition details are properly recorded. So the nature is one thing, classification is one thing. Secondly, the date of purchase, the invoice number, the amount, all those things are accounted properly or not, you will be seeing here. Whether correct rates are applied or not. Though you have classified it properly, but wrong rate is chosen means it is wrong, right? So classification can be, for example, a building is there. That building has a life of say 3 years, then depreciation rate is different. Suppose the same building, it is a concrete building, then the depreciation rate is different. So classification, you have done it rightly under buildings. But if you do not choose the right rate of tax, right rate of depreciation which is applicable to that building, then again there is a chance of misstatement of profits. So therefore, you should see the tax rates and accordingly apply it on this depreciation on these assets. Is it clear? Any doubts still here? Any doubts? It is clear. So whether addition and deletion is properly dealt. Suppose there is a deletion, what happens? Suppose there is a deletion, what happens? From the block of asset, we will reduce so much. How much will be reducing it? The sale value amount, whatever is the amount, so much will be reducing it. So much will be reducing it from the written down value of that block of assets. Suppose there's an addition, what happens? The purchase price will get added to the block of assets. So in this way, whether the addition and deletion is properly dealt or not is what you have to see. Suppose in the block of asset, there is only one asset and that asset is being sold. What is the treatment? Suppose there is only one asset in the block and that asset is sold. So in such scenarios, what happens is when the block ceases to exist, then we have to do the capital gains computation. It will be a short-term capital gain. We have to do the computation and see whether there is a gain or loss and accordingly take that in the books of accounts. But generally what happens if it is a small deletion means it will get reduced from the written down value and there will not be any other implications. So next, what is it? A major block of assets. The major block of assets that is there is buildings, plant and machinery, furniture, and intangible assets. There is different rates specified for each of the block, and the same rate should be used, and it should be classified accordingly in the similar groups. Now, what is the last point? The last point is that the WDV at the beginning of the period and ending period should be very carefully considered. What happens usually in the depreciation calculations, the previous year tax audit report, whatever is the closing WDV values, the same values you will be importing it. Basically, it gets imported. If you are using Winman and other softwares, it gets imported. So the system does the whole job. But what is your job? Your job is to see whether the asset, each block, what is the WDV as on the previous year closing date, whether the same amount is coming in the current year or not, you have to see that. Is it clear? Is it clear? Any doubt in this depreciation? Can we go to the next slide? Okay. Deduction under special sections. See, this is a very big clause, I would say, but very rare clause. So this will not be applicable to most of the assessees. Only few assessees will be coming under this category. So there are few specified sections under this clause. Suppose, say it is like assessee can claim deduction under section 32 AC, AB, ABA, 35, 35 ABB, 35 AC, 35 AD, 35 CCA, 35 CCB, 35 CCC, 35 CCD, 35 D, 35 DD, 35 DDA, 35 E. So in this nature, whatever is the deductions that we are claiming it, then if we are claiming any deduction in this nature, then this clause will get triggered. So as I told you, it is very rare. But having said that, we should know what precautions should be taken, right? What should we do if such a category of expense is there? Means what should we do is what we will be discussing here, subject to the terms and conditions mentioned in this section. So whether this deduction is claimed as per the conditions specified in the respective sections is what we have to see. That is the first point. Second point we have to see is whether it is eligible, whether it is we are eligible to claim deduction under the respective section or not. So we have to read every clause, every section where we are taking the benefit. That section we have to read and we have to see whether it is eligible for us or not. If we are not eligible, then we should not claim it. So this verification becomes very important for us because As you all know, tax audit is a true and fair, true and correct concept. It is not true and fair. A stat audit is true and fair concept. So therefore, we have to exercise a lot of care and precaution, and we have to ensure that if they are claiming such deductions, whether they are eligible or not, and all these other points, we have to ensure it. So what is the next point? Whether relevant conditions are satisfied under the section. So each section says there are certain conditions for it. So whether those conditions have been satisfied or not is what we have to check in this clause. Whether approval from relevant authorities or prescribed authorities is obtained or not. So in certain cases, we will have to, the assessee will have to take approvals from the government. So whether those approvals have been obtained or not, also we have to verify it. Whether relevant reports are obtained in support of deductions claim. See, certain sections here says that you have to obtain a separate report from the chartered accountants. So in such scenario, whether those reports have been obtained or not, we have to verify here. Is it clear? Any doubts in this clause? Any doubts? Okay, let's go ahead. Employee bonus or commissions in the nature of profit or dividend. See, let us see the clause first. Any sum paid to an employee as bonus or as commission for services rendered where such sum was otherwise payable to him as profit or dividend. So they are asking us to disclose if an employee has received any bonus or commission. And is it just ending there? It is also continuing telling that actually those amounts should have been paid as profits or dividends. So if that is the category, then we have to disclose that amount here. But what is this section 36(1)(2) saying? This section is telling that any sum paid to an employee as a bonus or commission for services rendered where such sum would have not been payable to him as profits or dividends if it has not been paid as bonus or commission. So what they are telling, generally it is a bonus or commission. Therefore, it is allowed, they are telling. The section 36 is about all general deductions. Yes or no? Section 36 is about general deductions. So this general deductions, it will allow all the amounts which is paid as bonus or commission to our employees. But when it is in the nature of any profit or dividend, where it is in the nature of this category, then we have to disclose that here. Is it clear? Is it clear? Yes. So the next clause, the clause B says details of contributions received from employees for various funds as referred to in section 36(1) VA. So what they are telling here, every employer in certain scenarios will have to get registered under PF and ESI. If the employee count is more than 20, PF is applicable. If the employee count is more than 10, ESI is applicable. So when these applicability criteria satisfies, so the employer has to get registered under PF and ESI. So when they get registered, they will have to make some contributions for and on behalf of the employee, and employee also needs to do some contributions. Say if it is PF, say 12% should be made by employee, 12% should be made by the employer. Is it clear? So employees and employer, both of them should make the contributions. So in case where it is a contribution received from the employees, say 12% which is received from the employees for PF, whether those amounts has been paid within the due date or paid after the due date is what they are asking here. Now what does the section say? Section says that if this amount is not paid within the due date of the respective statute, due date of the respective statute and not the income tax return filing due date. So, so it is the respective statute due date. So what is the due date for PF? Can you answer? What is the due date for PF? What is the due date for PF, ESI? Can answer in the chat box. Fifteenth of the next month. So Bhanu is telling 15th of the next month. So suppose this PF, whatever we have collected from our employees, we have not deposited within 15th of the next month means, then that amount will not be allowed as deduction for us. It will be considered as income instead. So that is what this table, the whole purpose of this table is to calculate, is to see whether the PF ESI amounts has been paid within the due date or not. This is what they are asking here. Is it clear so far? Any doubts? If you have no doubts, we can just walk through the 3CD form once. What if it is paid after due date? See, if it is paid after due date, the relevant statute related, PF related, ESI related compliance has been satisfied. But in our case, when we have not made the payment before due date, that amount will be considered as income. It will be considered as income and we'll have to pay taxes on that. That is the consequence. Any doubts still here? Can we run through the 3CD form once? If nobody has doubts, we can just run through the form once. Very good. Let us start. Yes, so this is the form 3CD. So here you can see there are two parts here, part 1, part B. Part 1 basically captures all the basic employee details, basic associate details, its PAN number, its GST numbers, date, all these details. And they're also asking the trigger point. Why is the tax audit getting applicable? So that point we are giving here. So part B is what we have discussed today. So part B, as we discussed, a quick recap. In case it is a firm, then we have to disclose the name of the partners, name of the members, their profit sharing ratios. In case it is there is a change in partners, members, or change in profit sharing ratio, then we need to disclose those details under clause B. So under clause 10, what are they asking? Nature of business or profession. If more than one business or profession is carried on during the previous year, nature of every business or profession. So if it is more than one business, then we have to specify all the business here. If there is any change in the nature of business or profession, the particulars of such change should be disclosed here. So whenever we are changing business, say from retail to wholesale, then we are going to disclose it here. Whether books of accounts are prescribed under section 44AA, then list of such prescribed, whatever is prescribed. So 44AA prescribes what books of accounts should be maintained. So what are those prescribed ones, and what are those which is maintained by the assessee, and what are those which is examined by us? So all these three things is getting covered here. Method of accounting employed in the previous year, whether it is cash method or whether it is mercantile method, those details we are giving here. Any change in method of accounting, we have to give the disclosure, we have to disclose that here. And if it is positive that there is a change in method of accounting, then impact of that, whether there is increase in profit or decrease in profit, this table should be filled up. Is it clear till here? Up to 13C, is it clear? Can you write in the chat box? Yes. So So 13D. So what is it telling here? 13D. Whether any adjustment is required to be made to the profits and loss for complying with the provisions of the ICDS, they are telling. So as I told you, if there is any deviations with respect to the ICDS, then should we do any adjustments is what it is talking here. Suppose there is a deviation, then we have to do the adjustments. So this clause will be yes. So if that is yes, then each ICDS per se, we have to say what is the impact on the profits, whether it is increasing the profits or decreasing the profits, and what is the impact, all that will be disclosing here. Is it clear here? So how many ICDS is there here? There are 10 ICDS. There are 10 ICDS here. So from each ICDS perspective, we'll be telling what is the impact that it has got on the net profits. See here, as I told you, every ICDS per se, we have to do the disclosures. Accounting policy per se, what is the disclosures that they have specified? Those items. Valuation of inventories per se, construction contract per se. So from each of the perspective, we have to do the disclosures. This is the inventory point. Method of valuing the closing stock. Usually it will be cost or NRV, whichever is lower. In case deviation from the method of valuation is prescribed, then effect of the same here. So the deviation, as we discussed, like whether we are accounting the purchases, sales, closing stock, opening stock, inclusive of taxes or exclusive of taxes. If it is inclusive of taxes, no changes has to be done here. Whether if it is exclusive of taxes, then we need to disclose that here. On account of purchases, what is the increase in profit? On account of closing stock, what is the increase in profit? On account of opening stock, what is the increase in profit? Like that, we have to disclose it here. Give the following particulars of capital asset converted into stock in trade. So whenever there is a conversion, then that conversion related asset details we have to give here. So we have discussed this. Amount not credited to the profit and loss account. So if it is say some benefit that we have received, some travel tickets or some benefits in kind, then we'll have to value that and put the amount here. If there is any capital receipt, we have to put here. This is a residuary clause. If there is any other type of income, then we have to add it here. So where there is any land or building that is transferred during the previous year for a consideration less than the value adopted by the state government. So as we discussed, under 43 CA, it is a non-capital asset. Under 50C, it is a capital asset. So in those scenarios, if the value of sale value is less than the stamp value, then in that scenario, we'll have to fill this table. Depreciation, description of the asset. So what block of asset we have to disclose here. Rate that is adopted for that block should be added here. Actual cost or written down value, as the case may be, should be added here. Adjustment made to the WDV on account of section 115 BAC BAD. So suppose we are going under the lower taxes. Suppose it is say 22% taxes or 15% taxes, then this clause gets triggered. So if we are going to those clauses, then we cannot claim the accelerated depreciation and things like that. So in such scenario, whatever adjustments is there, that adjustments we have to do here. The CA, CB, CC is all in relation to that. Depreciation allowable. What is the depreciation that is allowable for the year? See, the good part here is what is the depreciation allowable they are seeing from the child accountant. The same amount should also they will compare it with the income computation what the assessee has done in his income tax computation. So they will compare this depreciation amount with the depreciation amount which the assessee has done. So there could be a scenario where the auditor is only giving the tax audit report and the assessee himself files his returns. So in such scenario, if there is a different view by the assessee that his depreciation should be X and depreciation as per CA is Y, then department will easily issue a notice here. So in that way, this depreciation allowable will be compared. What is the return down value at the end of the year? what is the amount that as per our calculations and what is the amount as per assessee's calculations, that will get compared here. Amount admissible under the section. So these are the special sections that we discussed. So these are the special sections. What is the amount that is debited to profit and loss account, and what is the amount admissible as per the provisions of IT Act. Say for example, in certain sections, the amount that is debited to P&L account is say 100. The section allows us to take benefit up to 150 or 300 as well. So in such scenarios, they're asking what is the amount that is debited to profit and loss account, and what is the extra amount that the assessee is eligible to claim. So that extra amount will get adjusted to the income tax computation, which will be done after the tax audit report. In that way, they are trying to capture what is debited and what is admissible as per the IT records. So the next clause is any amount paid to an employee as bonus or commission for the services rendered, where such sum was otherwise payable to him as profits or dividends. So any sum payable to the employee. So whatever, as we discussed earlier, if it is genuinely payable as bonus and commission, nothing to worry. But if it is paid instead of profit and losses, profits or dividends, then that will get disclosed here. Details of contributions received from the employees for various funds as referred in section 36(1)(5)(a), that is the PF, ESI and other things. I hope it is clear. Any doubts still here so far? The other clauses are covered by the other presenter, I believe. Tomorrow we'll be discussing from clause 33, if I'm not wrong. Any doubts?
Sir, I have a small doubt.
Yes.
This happened with one of the clients in my office. So there was a case where one item, they have not considered it as a capital asset. However, when I saw, I thought that it should be considered as a capital asset. The situation was like this: the amount was not so material, say 1,000 to 2,000, but the period or the life was more than 1 year. So my mind, I was thinking it should be capitalized, but the client was of the view that it is not even material, and if we capitalize again, we have to track, depreciate, and then write off. All these things will be there. We don't want to. So as a tax auditor, I was really not sure how I should, deal with this.
See, one thing is materiality is a very important concept that we should keep in mind. See, if it is a turnover of say 100 crores, 200 crores and things like that, this 1,000, 2,000 will really not matter to the client. Yes or no? So now in such scenarios, if you just put this amount, one amount, it will not impact in any way for the client. There is another one clause which talks about capital expenses. Let me bring your attention to that clause. Clause 21, I think. See, capital expenditures. Please furnish the details of the amounts debited to the profit and loss account, being amount in the nature of capital, personal, advertisement, and advertisement expenses. So, suppose there is an expenditure which is material, for example. A small amount, you will not do it because materiality concept will always be there. And secondly, entities will have its own accounting policies. You have to check the accounting policy which the entity has adopted, and as per the accounting policy, if they have mentioned that the threshold for capitalization is say 5,000, 6,000, then the whole thing changes. So here, if it is a capital expenditure which is material, you feel, then that amount is they have not debited. They have put it into the. They have debited to the profit and loss account. Means then you have to highlight that point here.
Okay,
Is it
sir.
clear, John?
Yeah, got it, sir.
Yeah. Any other doubts? Everybody have understood? Any doubts is there? All of you have been doing tax audits from morning and from many days. So these clauses, whatever is there that we discussed today, it should be understood. If it is not understood, then it will not serve the purpose at all. So now, first thing is you have to understand. Second thing is you have to see what they're asking for. So this becomes very important for us. Based on that, we should see what has to be disclosed and things like that. So tomorrow will be our next session. I would request all of you to read the other clauses once before coming to the session, so that we can understand and appreciate it better. What is our topic for tomorrow? Clauses. Clauses 32 to 44 is the topic for tomorrow.
while मैंने बोलने hello
Hello.
So Kaushik sir, it was actually a great learning, sir. And thank you so much for your valuable time for all the students in spite of your busy schedule. It was great, and your question and answers, it was actually great, and we loved your session. So hope you keep in touch and do have such more sessions for SICASA Bengaluru. And thank you, sir.
Definitely. Thank you, Sumitra. Thank you for your kind words. Very happy to teach you all. I hope the concept was clear and you guys have understood it.
Yes, sir. Yes, it was indeed a great session. I think everyone loved it. The chats were evident.
Yeah. I would like to see more responses tomorrow, because one thing is only through chat we can interact. In other cases, what happens if it is a direct face to face? No, we can all see each other and discuss. But here that facility is not there, so we should make best use of this chat box.
Yes, sir. Yes, sir. Sure. Thank you, sir.
Thank you, Sumitra.
Sir,
Thank you, all of you.
One small request, sir.
Yes, sure.
In the tomorrow session, would it be possible to shed some light on special avoidance arrangements as well?
Special avoidance arrangements is in those clauses, no?
30, sir, 30.
30, is it? Okay,
Yeah.
okay. I'll include that.
Yeah, thank you so much, sir.
Welcome, no issues. Okay, thank you all then. We'll catch up tomorrow.
And everyone out there, thank you so much for joining today. And tomorrow will be the last session of tax audit. So hope you all make the